And the reason I wanted to do this episode is because I'm getting so many people that are coming to me and saying, "Hey, I'm ready to go. I'm ready to go." And I'm looking at them and go, remember that attractiveness and readiness? You might be ready, but you're not attractive, right? So you got to be
Right.
attractive and ready.
Hello, everyone. Welcome out to another episode of the PNP Industry Insider Podcast, where we take a look at what is changing in the pest and lawn industries, and we take you to the front lines to those that are driving those changes. I'm Donnie Shelton, owner of Triangle Home Services, which has Triangle Pest as well as Triangle Lawn. And with me, as always, is the infamous Mr. Dan Gordon. Dan, would you like to say good morning? Talk about yourself because but let's keep it down to at least under 15 minutes about yourself. Talk about our guests, our topics, our sponsors, and then let's get to it after that.
Oh, my two favorite topics, myself and anyway, Dan Gordon, PCO bookkeepers, M&A specialists. We do uh, exit planning. We do CFO work, bookkeeping work, tax work, et cetera, et cetera. And okay, so let me go through this. Here we go. This is Donnie Shelton. This is before we talk about our sponsors, I'd like to introduce the topic and guests for today. The topic is a really interesting one, and I'll tell you how it got developed, but it's a exit by design, not by exhaustion. The difference between a planned exit and a desperate one. And our two guests are our two favorite people. That's Donnie and I. And let's see. Let's talk about our sponsors. So our four main sponsors who we love. First one for marketing services, Colmarch. Partner with them, fueling growth for pest control, lawn care pros. They help you scale smarter. Get your first month free. Go to colmarch.com/podcast. And more than 40 years, and I think like 5 years or 4 or 5 years just as a sponsor for us is PestSure. And they've been protecting pest control companies and specialized insurance and safety programs because nobody understands the industry better. Learn more at pestsure.com. Voice for Pest, we've been involved with those guys for quite a while, and they've got all these great new AI features and whatnot. If you want, learn more at voiceforpest.com/podcast. And our newest sponsor, who we really enjoy working with, they're always a lot of fun, is Forshaw, leading family-owned and operated distributor, serving pest management professionals since 1961. Their focus on people, partners, and performance is what inspired Foresight, which is an inventory management tool that's actually pretty cool. It's built to bring clarity and support smarter operations. Learn more at forshaw.com. And boy, oh boy, if you're interested in one of our peer groups, which is really getting quite a bit of traction, and we really enjoy them. They are facilitated by David Billingsley, and industry veteran, and you can go back and listen to episode 238 with Caleb Cunningham of Justice Pest Control. He's a member. He'll tell you what it's like to be part of a peer group. And anyway, let's get started. So I am going to frame this, if you'd like. And the
Well,
reason,
before you do that,
oh, go ahead. Did I forget something?
you did not. I'm going to
Oh,
break the rules a little bit.
okay.
I'm going to give our listeners a little sneak peek of what's coming.
Uh-oh.
I'm not going to give them the dates yet, but I am going to give them the sneak peek of what's coming. Should we do this? Are you nervous, Dan? I'm going to do it. So
We just had a meeting about this. Is this?
yes.
Oh, okay.
So if you're listening, we are announcing we're going to have our very first ever PNP Industry Insider Conference. It's going to be here in Raleigh. It's going to be in December of this year. We're not giving you the dates yet because we're still negotiating rates, still negotiating locations. But what I can guarantee you is that it will be a wonderful conference. And if you want to grow your business, this is the conference you want to be at. You're going to have experts there. Of course, you'll have the two knuckleheads there. I'm speaking of Dan and someone else, not myself, when I say that. And with that, that's the special announcement. When we As we get more details, of course, we'll send out the details. I mean, we'll send them out to you, but just know that this conference is going to be all about growing your business. It's going to be all about how do you do things better. And we're going to grab the experts, right? And so it's one of the benefits of being an insider. And the goal is that when you leave, you have more ideas than you can possibly implement so that you can have one of the greatest years you could ever have going into 27. And with that, now we can get started, Dan. Knock yourself out.
Yeah, don't give away too much because we're still trying to figure this whole thing out. It's going to be amazing. It's going to be
Yeah,
fantastic.
it'll
But
be great.
anyway, all right. So let's talk about this. This episode was inspired by probably something that most people who listen go through at least once a week. They get a letter in the mail or an email or a phone call. Hey, man, want to sell your company? We're going to pay you a gajillion dollars, and everything's going to be great and whatnot. And
You know what I thought you were going to say? I thought you were going to say, like, I am so done. Please, someone come buy this business so I can just leave.
well,
When you were saying this goes through once a week, that's what went through my brain.
yeah, well, listen, you can feel that way, but that is not the day that you sell your business.
No, it's
Hard
definitely
to
not the
do it when
days.
you're
For
having a
sure.
bad day. But
Yes.
today we're going to talk about the difference between quitting your business and exiting it. So many owners wait for a bad day and decide that they're done, or they get one of those communications from private equity or whoever to buy, and man, the grass is always greener on the other side. But by then they've already lost their leverage, right? So we're going to dive into there's a institute called the Certified Exit Planning Institute, and I am actually a certified exit planner. I went through this course and took these exams, and now I have some more letters to put next to my name. So I need a bigger door on my office so I can put the my nameplate and my all of my things that I'm impressed with. But basically, what it is it's a methodology to show you how to start with the end in mind, and ensure that you walk away in 3 to 5 years, leaving maximum value with little regrets. Because the big thing is, hey Dan, what's my business worth, or what are the multiples today? And that's not really. I mean, listen, if you have a health issue or you've got to get out, that's what you got to do, right? But the way to do this is really to do some planning. So if I have a question for you, if you had sold your business on your worst day 5 years ago, what percentage of the final value do you think that you would have left on the table?
Do you mean like that I could have gotten versus what I would have gotten? Or do you mean like when you say the percentage of final value, do you mean I'm asking this question because I want to make sure that I'm clear with the question that you're asking, which is given the dollar amount that I would have gotten if I'd have sold it 5 years ago, or are you asking more in line of like percentage of, hey, you gotten this many dollars had you
No,
obviously,
more,
I think
more
I know
of
where you're going.
multiples, and we'll talk about like because what happens is we get lots and lots of people who want to sell their business, and their business is not saleable, or they're not going to get the value that they think they're going to get because it's kind of a retrofit project as opposed to a first. Uh,
Actually, I have two stories I think
yeah, go
would be
ahead.
helpful. The first one is Dan, I'm almost certain you remember the story because you were with me when this happened. I had a guy in our peer group who came in and he was big into pest one time. He was big into termite and he was making a good living. He was making about roughly about 2 million a year in revenue. And he came to the group and was talking about retiring in 3 to 5 years. And I laughed at him. I said, "Well, what are you going to do?" He goes, "What do you mean? I'm going to sell the business." I'm like, and I was, back in those days, I was a little bit more or less polished than I am now. But I was like, "Well, you have nothing
Yes.
to sell. You have nothing to sell. So I'm not for sure what you're going to plan on doing. But if you plan on selling this business, I don't know how you're going to retire." That's the first story. By the way, this guy ended up completely changing his business model. One of the best people I've ever seen execute a strategy and have it be successful. And within 5 years, he had turned that business completely around in recurring revenue, and it was an amazing business. And he did retire. The second story I have, and I can't use a name on this one because most people in the industry know him. He's on the lawn side. He talked about the idea of when he sold a massive lawn company, and he said we made a decision. It was a 3-year process. We interviewed here's a keyword. We interviewed several potential buyers, and through that vetting process, then we selected the right person. That to me says it all right there,
Well,
right? I mean, just
that's part of the process, right? So
yeah, yep,
reality is, and this is from this is a readiness survey that this CEPA organization did. They said that 80% of businesses that go to market don't sell. See, you don't hear about that because everybody in pest control is talking about, oh, this guy got that and this guy got that. A lot of family businesses, a lot of best in class businesses, and a lot of junk in the past was sold. But now, in order to get what you want, they're looking for higher end companies. And there are certain success characteristics that you need to build in order to maximize that value. If you want to fire sale it, that's a different story. Okay. But basically, when I look at a exit plan, it's not, hey, Dan, how much can I get for my company? Or somebody contacted me and told me that I can get all this money for it and whatnot. But it's basically, you want to de-risk the business and you want to de-risk your strategy, right? And so there's like this three legs of a stool, right? And this three legs of a stool, you've got to think about what are your business is one thing, right? You've got personal assets and you've also got personal goals and ambitions after you sell. So the first thing is to say, well, how much money do I need in retirement? Or if you're not going to retire, there's two types of sellers. There's the guy and gal who wants to retire and go off into the sunset. And then there's the guys who are a little bit younger who want to rinse, lather, and repeat and do it again and again and again, right? But both have an end goal and need a certain amount of money to make it happen. However, you're going to calculate that. But let's just take a simple model. Let's say that you need $200,000 a year to live your lifestyle right now, right? So at 5%, if I had $4 million in the bank, I can get $200,000. But let's say you're going to retire and you don't have this business, and now all of a sudden you want to travel and do a whole bunch of things that might cost you more than $200,000 a year. You have to figure that out, right? So then you say, okay, well, I need $4 million in the bank, and maybe you have investments of a half a million, so you need a $3.5 million gap, right? There's a wealth gap of $3.5 million. Well, if we say that your company's worth $1.5 million, right? Then our gap is $2 million, right? So we have a half a million of investments. I got $1.5 million of value for my company, and I have this gap that I have to make up of the $2 million, right? And so it's really important that you think that way. And then you say, because I may be able to get you a 10, a 50 multiple, but if it's not enough, it's not enough, right? So you've got to think in this regard. So it's a three-legged stool, right? There's your business, right? Which is most people who are in a small business or that's most of their, most of their net worth. Then you've got your financial. That's what you have on the side, whether it's investment accounts, real estate, whatever. And then you've got your personal plan. And that personal plan could be retiring, or it could be, hey, I'm going to take this money and go parlay it and go do it again somewhere else, right? But you've got to have a plan. And usually, in order to maximize the value or in order to get to where you want with this plan, it takes some time, right? Now, okay.
okay,
So there is a methodology to this. And the methodology is using a three-pronged approach as opposed to the three legs of the stool. And that three-pronged approach is to discover, prepare, and decide. So you're going to discover what you have. You're going to come up with a plan. You're going to prepare or execute that plan for a period of time, and you're going to decide whether, I did all of that. Do I still want to get out? Do I want to get out now? Do I want to get out next year, 5 years, whatever, right? Okay. Let me ask you before we go any further, how do you look at exit planning? And, everybody has a number. You remember that Fidelity commercial where the guy walks around with a number on his shoulder?
Oh yeah.
You know,
Yeah.
so how do you look at that?
So I've spent a lot of time on this. I say a lot of time, but I do have a number that I'm shooting for. I have a plan afterwards, and I'm actively and fully engaged trying to grow the business to that level and to really put the infrastructure in place. And by the way, my timeline is way out. I mean, I mean, I think I've said my age on this podcast, but I'm 50. I plan on going at least until I'm 60. So I've got more than 10 years. I have a really big number that I'm trying to hit. And I've thought, listen, I mean, I'm sure there's things that I'm missing, but big picture, I've thought about like what I want my life to look like. And listen, I don't want to sell right now, probably because I'm pretty sure Miss Shelton wouldn't want me home all the time. And years ago, I kind of retired a little bit, and it was terrible. I'm just not ready as a person to do
Yeah.
that quite yet. You know what I mean? Like I like chasing goals. I love business. I love our industry. I'm very much a part of, not only am I like financially committed, I'm emotionally committed. I'm committed to the people. Like I really enjoy what we're doing, and I can't imagine doing anything else. I really can't. I mean, like the idea of me going and fishing all day long, or you know, or just really just entertaining myself all day long. Like I'm just not there personally quite yet. And so I've thought about this question a lot because that's to me, it's the old adage of, beginning with the end in mind and then working
Sure.
yourself backwards from there. So,
So one of the things that we do is in this discovery phase, we have to figure out what the baseline valuation is. And you have to be really realistic, right? Because if you go out and you talk to your friends at the state association national, you go to the bar afterwards and you talk with people and this guy sold for this and this guy sold for that. Um, the market has changed a bit in the way that in the buyers, right? For a few years ago, several years ago, it was all strategics. It was the Rollins, the Rentokils, the Terminex when they were on their own, and to Cemex even, right? So those basically those guys will say, I'm going to pay you this for your company, and we're going to give you 85 or 90% down, and we're going to pay the other percentage in a year based on, some rep and warranty holdback. Now what you've got is the people who are really pushing this whole M&A world are these private equity guys. And these private equity guys, when they give you an offer, it's not that straightforward, right?
mhm.
It's a headline number with a potential earnout and management incentive shares and equity roles and all of these other things, right? So as somebody who's not studying this all day and every day, you say, okay, well, what is my business worth now? And we take it out and we go to one of these PE firms and they give you one of these offers. That's probably not what the company's worth. So essentially, what we want to do is we want to understand, um, you know, um, you know, you hear about these multiples, and I'm going to talk about multiples of free cash or multiples of EBITDA as opposed to multiples of revenue. A lot of people have always talked about multiples of revenue. I got two times, three times, four times, right? And you can't really
Right.
talk that way because you have $1 million company, I have $1 million company. You have five technicians, I have 10 technicians. These companies are not worth the same.
No, no,
Right.
it's all about what are you doing on the bottom line.
Right.
Some people forget that.
Right. So it's the bottom line. So
Yeah.
now let's talk about buying a liquor store or a bowling alley or something, right?
Oh, whoa,
Uh,
whoa. How do we get that way? We're
Well,
talking about
because I
pest
want to bring
control,
it
now we're
back
talking about
around to pest
okay.
control.
All
So,
right.
so when you go to a business broker and you say, I want to buy a liquor store or bowling alley, they'll tell you, well, okay, you're going to probably pay three or four times EBITDA or your free cash flow, right?
Hmm.
And so, when you talk about pest control, that number is significantly more, right? Pest control and lawn care have, we're in the right place at the right time, right? So these values are anywhere between 8 and 15. And, we've done deals as much as 20 times EBITDA, right? Now,
And just to be clear, the reason that is because it's predictable cash flow.
that's right.
It's
So
solid.
why? Okay, so you and I have the exact same company, and we have different valuations, different multiples. What is it that goes into that multiple, right? So maybe I told you 8 to 15 times, right? So who's the guy who's worth 8 or even 6, and who's the guy who's worth 15, right? And so what you have to really kind of do is um, do an analysis and say, how attractive am I to a buyer? And how ready am I to exit, right? So
Mhm.
Donnie Shelton is very attractive because he's a good-looking man, but
Whoa! Hang on. This is a
but
podcast about
but
business.
but he might not be ready, right? So like
Yes.
so Donnie's out there in the industry, everybody knows him, and so most people would say, yeah, let's engage in a conversation, right? But now we have to look under the hood and see what Triangle's all about, right? And
Mhm.
so what you've got to do is you've got to understand what these folks are looking for. And you brought it up. Recurring revenue is a big one, right?
Mhm.
Um, uh, Growth, good growth trend is a good one, right? Um, Good management, right? So one of the things that I've been in diligence where, the question is asked of the owner, you know, how involved are you in the business? And they're proud owners, and oh, I'm involved with everything. I do sales, I do market, I do operations. That is not what they're looking for. They
Right.
want to have a business that runs without you. That's a
Right.
business that's worth a bunch of money. So you've got to figure out, how do you extricate yourself from the business itself, right?
Right.
And that's an important one. Okay. So
Well,
let's stop there.
Michael Gerber, I think, said it best when he said, the business is the product. Yeah, and you really can't lose sight of that. You have to understand, like, the business is the product.
Yeah.
So, um,
Okay. So we've got a company that, by the way, if your business is making a lot of money because you do a lot of insulation and crawl space encapsulation and bird jobs, all high margin business where you're making a whole bunch of money, that business is not as predictable and de-risked as a recurring revenue model. I'm not saying anything that anybody doesn't know, but there's a couple of gaps here, right? So we have that wealth gap that we talked about. So I got to get an extra $2 million in purchase price. And then you've got this value gap. And this value gap is the difference between that 6 or 8 times multiple and the 15 times multiple. Okay. So when we look at that, what are some of the other things? So we said growth, we said recurring to non-recurring, obviously selling at a high margin. But we also want to make sure that the business can operate without you, the owner. So you have to look at your human capital, right? Do you have a strong middle management team? Are you are you the guy who's solving everybody's termite problem, or are you the conductor of the orchestra? Right?
well, let me just for a moment. Let's just go big picture here. And so, if you're listening to this, I mean, there's really a couple things. Number one is I like one-time services. I'm not a
Mhm.
hater, but I like it for generating cash. I have no expectation that it's going to build into my valuation model. And the reality of it is that you want to do both, right? You want to generate cash and generate value. That is the fundamental, that's the fundamental thing that you do as an owner. I generate cash and I generate value. And so there's that piece, but then there's other piece that you're talking about, which are kind of non-tangibles that a lot of people don't think about, which is how predictable is your revenue model? And it's a lot more than just recurring revenue. It's your platform, right? Is your business truly scalable? Is your business like if someone else bought your business, can they run it to the level that you do? And it's funny, yesterday I was talking to a guy who did M&A for like these coal mines. He worked in West Virginia and he bought these old coal mines. And he said, we stopped doing small acquisitions because we couldn't run those mines like the owners could, you know? It's like, the owners are they were so involved. And I mean, I'm not a coal miner, never have been, but the reality of it is like he was just explaining that, when they're that small and they haven't built it out, they stopped buying them altogether because they knew they were buying an unpredictable revenue model. And that's really the same thing here.
So that human capital, right? So is really important. And when you do exit, that management team that you've put together is extremely important and is one of the intangibles that help with that value gap, the multiple. Like, are you getting eight or are you getting 15, right? Um, the next one, and this is kind of, I would imagine that most of our listeners really embrace this, especially because if you break down what our podcast is about, yeah, it's about pest control and whatnot, but a lot of it is technology, right? So, structural capital. Do you have SOPs? Do you have clean data? Is everything in your business automated? And technology is really, really, changing it's changing all industries, right? But are you on the forefront of it or on the back end of it? By the way, we definitely get like old time companies that come to us and say, and they're very profitable, right? The owner doesn't want to change a lick because, don't mess with it.
It's working. Yeah, don't fix things that aren't
But
broken.
but the technology is 20, 25 years ago, And so what does that mean? By the way, if you're thinking of a 3 to 5 year runway, everybody hates their software at a different level. So if you're going to change your CRM, don't do it a year before you plan to exit. That is a disaster. You've got
Hmm.
to be out at least 3 years. In other words, your transition to new software needs to be before the first year of the 3 years that you're thinking about exiting, right? So technology is extremely important. So your structural capital, how do you build that to best in class? And having your CRM, it's kind of interesting because um, the beauty of the pest packs and the field routes and all of the CRMs that are out there is that they're very flexible. The worst thing about the CRMs that are out there is that they're very flexible. And so if you don't have strong SOPs and you have somebody who is a strong personality running that thing, and they decide somebody calls up and on the fly they add a new service, right? With no protocols or whatnot, but they just put it in the computer, quarterlies without bees or something like that, right?
Hmm.
You can't let them do that, right? So everything has to be structured. And by the way, if you run a good pest control company, it's boring. And a lot of owners get, oh man, I gotta improve. I gotta improve. You always want to be improving, but don't let it, uh, you know, don't go too far away from the model because the model is simple. The business is not easy to execute, but the model is simple. I will stop
Right.
there for a minute before we talk about customer capital.
Okay. Well, I think the main thing there is just making sure that you understand that this is a process and whatever once you've kind of thought through like this is going to be the timeline, this is what I'm thinking in terms of my number. Think about a year that's going to happen and then back up 3 years and be like, okay, it's time to go in lockdown mode, but to make sure that I have everything in place. Because to your point, swapping CRMs, doing things anything that you do to add unpredictability is only going to drive down your valuation. And so when you get ready for that point that you're interviewing people to invest in your company or to buy you out, you want to, as much as possible, eliminate the risk for them because you want them to know that if they're buying you, what they're buying is absolutely solid and you take out as many risk as possible.
You want clean sailing for 3 years, right? Or
Right.
more, but 3 years minimum, because that's usually your diligence period. Okay.
Right.
The next thing that you want is customer capital. We talked about recurring revenue being king, but how about uh, customer concentration risk? You don't want that big commercial account to count for 25% of your revenue. That's problematic in valuation. Okay.
Mhm.
Um, Not saying that you shouldn't be in commercial, but what I am saying is that don't let your customer base be dominated by one or a few customers. You should have a completely diversified customer base, whether it's commercial or residential. Yeah.
And that makes I mean, that makes a lot of sense, right? I mean, the idea is that it's again, it goes back to that whole risk model that they're doing when they're looking at what they're buying is how solid is what we're buying? How solid is this going to be in a year? And if you got some massive account, it's not very solid because it's just I mean, the reality of it is they could lose that account, and then what they've paid is greatly reduced as far as like what they get back, their ROI. So again, if you take anything away from this setup, it's how do I de-risk for the buyer, so that when they purchase, it's up to them to mess it up, not structurally something wrong with my business that only I can do it, or there only one customer is really driving all the revenue. So
Okay. So you've got human capital, that's your team. You've got structural capital, that's your processes. You've got customer capital, making sure that you have recurring and non-concentrated risk and also route efficiency. Then you've got social capital. What's your brand like out in the out in the market? Are you the guys who everybody says, they're a big company, but they don't execute well? Or do you have a lot of hate going on social media? Or do you work within the community and do you have a good reputation? Right. So
Mhm.
those are the four capitals of value that I like to discuss: human capital, structural capital, customer capital, and social capital, right? And so you've got to get those in line, hopefully before this 3 year window. And during the 3 years, you're just kind of, it's smooth sailing, you're growing, everything's looking good because that's going to get you the highest value in terms of multiple. Remember this value gap, right? Okay. And then, um, you know, uh, when you look at those four things, you're going to de-risk your business by identifying these value killers that maybe you have you're lacking in your the leadership of your team, and you've got to go out and get that person or those people, or that your SOPs are weak, or that your technology is not that good, or that you have customer concentration risk, right? So basically, what we're saying is let's assess our business. We need to understand the wealth gap. That's how much money, the calculate what you have before the value of your business. Okay. Calculate what you need, add the value of your current business today, and then the gap, that wealth gap, is what we need to increase in order to get to where we want to be. Now, the second is the value gap. Are we going to get a 6 multiple or a 15 multiple and beyond? And how do we, how do we regulate that? We regulate that with the four types of capital. Okay. And then what we're going to do is we are going to decide, right? We're going to improve this thing. We're going to make it profitable. I know a lot of people who they really they're at their wits' end with their business and whatnot, and so they want to sell it, and then they say, okay, well, I'm going to do what you say. And we've had people improve their business, and then they go, maybe I don't want to sell it. It's not bad. By the way, is cash king or is cash flow king, right? What would you rather
Right.
have, right? So
Yeah.
the beauty of a well-run pest control company is it's an annuity that goes on forever as long as you keep.
And let me just add, you can adjust for inflation and you can control it all and you understand it and all the things that you look at the great investors of the world say, which is have a lot of control, understand what you're investing in. Like I just don't know of anything better, especially when it comes to this. Not recommending that you don't sell if you're ready to sell. I'm just simply making the point that if you've built a cash machine and you're not done, I wouldn't be in any hurry. That's for sure.
Mhm.
You know what I mean? I just would not be in a hurry. Um, There's one other point I wanted to make as well, which is, when you think about this, there's a story I remember, and again, this person, I'm not going to say who it is because they're back in the industry again, doing it again. But this person back in the day was, they had what I thought to be a very successful company. Turns out when you got under the hood, this guy was all grow and no profit, and he ended up selling to a company outside of the industry. And didn't get the best price for it, and it turned into a complete dumpster fire because what happened was is he grew so fast and he spent so much on growth that he forgot that, well, the real value of my business is what I'm doing in profit along with growth. It can't be all grow and so anyway, it ended up kind of badly for him because he had to sell. He had to sell. Otherwise, he was going to be bankrupt, which is unheard of in this industry, right? I don't want to say it's impossible, but it's really rare you see someone bust out, unless it's like, I mean, and I'm not picking on door to door, but it is, guys, it's very easy on the door teams. They can run out of cash fairly quickly. But even then, I think they just grab investors. I can't think of any off the top of my head who just really would belly up. But this person ended up having to sell early because they were all growth minded and did not even think about what was going to go down on the bottom line and ended up biting them pretty hard. So just
Well, by
remember
the way,
that.
you bring up the door model, and I am all in. I love door to door, right? If it's done properly. But it's the guys who come to me and say, "Yeah, I, opened up in, Timbuktu, and we were there for a year and a half, and my company, I'm thinking that it's worth three times." No, there's many ways to value a business, and one of them is to value an annuity, right? So an annuity. So if I say to you, "I'm going to give you $200 for 5 years, every year for 5 years." The present value, meaning you discount that back to today, that's the value of an annuity, and that's a 5 year annuity, right?
Right.
So I have an imputed interest rate. That's my required rate of return. I have the $200 and I have the 5 years. Well, with brand new companies or companies that have been around for a year, the most important variable of those three variables is the life of a customer. And I don't know what that is, right? So if you have a customer for a year and a half, you're going to be hard pressed for somebody buying that business for maximum valuation. If you're going to go into this, it's not a matter of building and then selling after a year. That is a strategy, right? If you can build it cheap enough, okay, but you're not going to get big valuations. The big
Right.
valuations come after 4 to 5 years so that we know what the life of a customer is, right?
Hmm.
Then you start to build those values, and you have to look at your attrition, right? Because people who build companies really quick usually have high attrition rates because they have such an aggressive sales tactic, right?
Right.
So
Right.
that's important, right? So again, this pathway to exiting, that's that 4 or 5 years, right? You
Right.
don't that it's fun to entertain those emails and hey, we want to buy your company and everything and have those conversations. But the way to maximize the value of your business, because if you're in your 50s or 60s, you probably have one shot at this. If you're in your 30s, maybe you'll do it 3 or 4 times, but it's not an unlimited number of times, right? So you want to make sure that you maximize it each time and you take the time to do it. Okay. So let's go back to, okay, so we discover what's our business worth, what do we need? We prepare, okay, in order to get to where I want to be, here's the plan. And then you execute the plan and then you decide, are we getting out? Are we staying in? Are we going to get a strategic partner who buys in and we keep a piece of it? There are many different options. And another big option is, what do your kids want to do? Are your kids interested in it? And that's a whole separate topic that we can take on at a different time. Okay.
Sure.
So
Yeah.
those are some of the things that we look at. And the reason I wanted to do this episode is because I'm getting so many people that are coming to me and saying, "Hey, I'm ready to go. I'm ready to go." And I'm looking at it and go, Remember that attractiveness and readiness? You might be ready, but you're not attractive, right? So you got to be
Right.
attractive and ready, right? Okay.
I get that a lot. Not
Yeah.
attractive, but
Yeah. Well,
um, you
I,
know, I listen. There are a couple things I want to finish out with, and I think this is really important. Is we have all kinds of listeners who listen to the podcast. We have multi-million-dollar companies who are listening to it, who have a well foundation, a big infrastructure, and this is probably not a big issue for them, and they may be generational, right? But we also have kind of our, our upstarts, or these people who are just getting started. And I'm one of those people, right? I mean, Triangle was started in the back of a truck, and truly, I remember, as I had to make this transition from being the guy who did everything to being an owner who was very much more strategic. For me, I had to build time in for that. And the way I did that is every morning I took 2 hours. I turned off my phone. I shut my door. I gave, back then it was like, two other people, one other person in the office. And I said, listen, if someone's on fire, then you can knock on that door, but you can leave me alone for 2 hours. And I sat down and wrote procedures and basically processed out my business. And listen, that was back in the day, back before AI. You could do that a lot faster now. But I mean, this whole idea of just like, I just made it a point that the only way I get out of this is I have to sit down and build the model. And I would say, if you're listening to this, there's no way out of this unless you sit down and build the model. There ain't no way around it. And so if you're like, I'm not good with procedures, or I don't, it doesn't really matter. Find someone who is. Use AI, for goodness sakes. I mean, my gosh, it's so easy now. And so, the whole idea here is that you just need to take the perspective that the business is the product. That's what you're building, right? It's not, obviously the service is a piece of it, but what you're doing is you're building a product for someone else to sell, and the business is that product. That's what you're really, really doing, not just producing a
don't
service
let
on the
your
door.
ego get in the way to say, I'm the guy. No,
Correct.
when you're the guy, you want to be out, right?
Right.
You want, this business needs to operate by itself.
Or, let your ego rest on the fact that you built just the most amazing model,
Mhm.
through other people. Just misplace it, right? Or place it in a different spot. Because if you think you want to be the hero, your ego is misplaced. So nothing wrong with having ego, nothing wrong with doing that. Just put it on real winning, not faux winning. So, all right. Anything to finish out here, Dan, before we're all done?
I do remember. So, the quote, hope is not a strategy.
Yes.
The one thing is, I would say that exit planning is just good business strategy. Start with the end in mind. And if you've already, you're not starting, but you're well on your way, think about this now. Not, maybe you want to get out in 5 years, 10 years, 15 years, but you've got to, you need a roadmap to get where you want to go. And so you've got to design that.
Okay. Cool. Good,
Good.
good, good. Well, just a reminder, all the resources and topics that we talked about today are going to be available on the podcast website. Just take a look at pnpindustryinsider.com. Take a look under show notes. And as always, we appreciate any ratings and reviews that you have, so long as they're positive. And of course, the negative ones go to Dan, like I always say. And listen, this episode, I'm telling you, if you follow what we have said, and not that we're experts, there's nothing new under the sun, but when I gave that example up front about the guy who thought he had something to sell versus the guy who knew he had something to sell, and he interviewed folks and had a 3-year timeline, they were vastly different in valuations. And so we're just trying to help. Hopefully that's helped for you guys.
By the way, anybody who wants to discuss this or is thinking about it, just email me. It's dan@pcobookkeepers.com. Happy to give you a little bit of time, and we can talk about it. So,
Love it. All right. And with that, we'll sign it off. We'll see you all next time. Take care.
yeah, see ya.